These three dividend stocks have all taken a hit lately, but that's exactly what puts them on my radar. I'm not chasing yield here, I'm just looking for quality companies that have been beaten down with long-term upside and reliable dividend growth. I'm Nick and this is the Dividend Growth Income channel. In today's video, I'll break down 3 beaten down dividend paying companies that I think are worth a close look this May. I'm personally adding to 2 of them, and the third is firmly on my watch list as a potential turnaround play. Let's get into it. Stock number 1 is United Health Group, ticker UNH, and we're talking about a leading healthcare and insurance company. This is a business where most of its fundamentals are solid, strong revenues, consistent profits, and a long history of dividend growth. But despite that, shares are down over 20% year to date, and that's because of a slew of recent issues that have piled on in just the last year. First, there was a massive cyber attack on their Change Healthcare unit in early 2024. That hack disrupted nationwide claims and payment processing and ended up costing United Health over $6 billion to support impacted providers. Second, they've been facing increased regulatory scrutiny, including an ongoing DOJ investigation into Medicare billing practices, specifically whether the company added questionable diagnoses to boost payments. United Health denies the allegations, but the probe has added pressure. And third, in late 2024, the CEO of United Healthcare, Brian Thompson, was tragically assassinated, an event that shocked the healthcare industry and drew widespread media attention. Beyond the internal leadership transition, the incident also ignited renewed political debate across the state of healthcare in the United States, particularly around costs, insurance practices, and Medicare Advantage. Members on both sides of the political aisle have since floated potential reforms, and that uncertainty adds another layer of risk to companies like United Health moving forward. And most recently, in April of 2025, the stock cratered over 22% in a single day, its worst performance in 25 years, after the company cut full-year profit guidance due to higher than expected medical costs, particularly in its Medicare Advantage plans. The above might cause an investor to panic and sell their shares, and to be fair, the headlines have been rough, but I see a solid business under all this that's been hit with a series of unfortunate, mostly short-term headwinds. United Health still dominates its space, it's consistently profitable, and has a long track record of rewarding its shareholders. Now let's talk about the dividends, because this is where United Health has been quietly shining. UNH has a dividend safety score of 90 from Simply Safe Dividends, down from its previous 99, but still ranks as very safe, meaning a dividend cut is highly unlikely. This downgrade was mostly due to pressures in the Medicare Advantage market, but the company is still with an A+ credit rating, $37 billion in cash, and an annual dividend commitment of just $8 billion. So that dividend only makes up 31% of forward earnings and 27% of forward free cash flow. Plenty of room for further growth. UNH has now raised its dividend for 15 consecutive years with a 5-year CAGR of 14.6, and the last raise was nearly 12%. The 16th consecutive hike is expected this coming June, and current dividend is $2.10 per share, paid quarterly in March, June, September, and December for a total annual payout of $8.40 per share. This gives us about a 2.1% yield, and this doesn't sound flashy or anything, but compare that to the stock's 5-year average yield of just 1.42%. By dividend yield theory, the stock looks undervalued right now. In fact, this typical low yielder has only offered a 2% plus yield once in the last 10 years, and that was during the COVID crash in 2020. So this is a rare territory for UNH shares. And when we look at valuation, I think the opportunity becomes even clearer. UNH is currently trading at a forward PE of 14.9 compared to its 5-year average of 20.2. This is a significant discount for a high-quality company, another strong indicator that the stock is potentially undervalued. The company has also been buying back shares consistently, from 967 million 10 years ago to 928 million shares today, which supports per-share growth and shareholder returns. And return on invested capital sits right around 14%, which is strong and suggests they've been allocating their capital efficiently. Leverage is very manageable. Net debt to EBITDA is just 1.15, and net debt to capital is 31%. So despite all the noise and recent headlines, their balance sheet is in excellent shape. Analyst consensus has a price target of $547.65. It just implies more than 35% upside from where shares are trading today. For a stable dividend grower with this kind of financial profile, sounds great. So despite the recent drama around UNH, the cyber attack, regulatory heat, leadership changes, and margin pressure, I think there's still a strong case to be made for the stock. The fundamentals remain solid, the dividend is rock steady with room to grow. The valuation suggests meaningful upside from here. So I've been buying at this level. I bought some today, in fact, this morning, and I'm comfortable continuing to build my position at these levels. Stock number 2 is Starbucks, ticker SBUX. This is a name that probably doesn't surprise many of you, but the timing might. Starbucks stock has been absolutely hammered over the last few months, and sentiment around the company is pretty negative right now. But when I look past the headlines and I focus on the fundamentals, long-term potential, valuation, this starts to look like one of the more compelling risk-reward setups on my watch list. Year-to-date, shares are down 10%. So what's going wrong? In Q2 of 2025, Starbucks reported a 2% decline in U.S. same-store sales and a 1% drop globally, marking its 5th consecutive quarter of declining transactions. Customers have expressed frustration over long wait times and inconsistent service, even with mobile ordering. The company's attempt to streamline operations through automation, notably the Siren Craft system, did not yield the expected efficiencies. In response, Starbucks is now shifting focus back to human labor, planning to hire thousands of baristas to improve service speed and the customer experience. Additionally, Starbucks faces stiff competition from emerging coffee chains like Dutch Brothers and Scooters Coffee, which are attracting customers seeking unique, indulgent experiences. Internationally, challenges persist, particularly in China, where local competitors and geopolitical tensions have impacted sales. But here's where it gets interesting. In August of 2024, Starbucks brought in Brian Niccol as CEO, a seasoned executive renowned for revitalizing brands such as Taco Bell and Chipotle. At Taco Bell, Niccol spearheaded innovative marketing campaigns and menu overhauls, leading to significant sales growth. At Chipotle, he navigated the company through food safety crisis, enhancing digital engagement and expanding the brand's footprint, which resulted in substantial increases in revenue and stock value. At Starbucks, Niccol is implementing a competitive Back to Starbucks plan, focusing on simplifying menus, enhancing store ambiance, and improving service efficiency. While the turnaround is still in these earlier stages, Niccol's track record suggests he has the strategic vision and operational expertise to steer Starbucks back to growth. So let's talk about their dividends, because this is where some risk, I think, does show up, but also where long-term opportunity could emerge if the turnaround does play out. Starbucks currently has a dividend safety score of 60 from Simply Safe Dividends, which puts it into the borderline category. That means there is a moderate risk of a dividend cut over a full economic cycle. This rating was just reaffirmed on April 30, so it's based off of fresh data. And frankly, the payout ratios reflect that risk. 91% of forward earnings, 96% of forward free cash flow. So yeah, things are a little tight right now. Free cash flow per share has been under pressure and has not shown consistent growth since the 2020 COVID crisis. But despite this pressure, Starbucks has remained committed to growing the dividend. Over the last 5 years, the dividend has grown at a CAGR of 9.3%, and the latest raise back in October was a solid 7%. I'm not expecting big increases in the next year or two, but if the turnaround were to stick, I think that track record of dividend growth speaks for itself long term. The dividend is currently 61 cents per share, paid quarterly in February, May, August, and November, for a total annual payout of $2.44. The next ex-dividend date is May 16th, with a payment on May 30th. So if you're interested in getting that payout, there's your window. Right now, shares are yielding about 3%, which is well above the 5-year average of 2.17%. This is a sign that Starbucks could be undervalued by dividend yield theory if the stock were trading at its more typical yield range. Starbucks is currently trading at a forward PE ratio of 30.6, which is slightly above its 5-year average of 28.8. So it's not screaming cheap on a PE basis, but that's also fairly typical for a high-quality consumer brand with global recognition. So one thing I do like is the steady share reduction over the last decade. In 2015, Starbucks had 1.51 billion shares outstanding. Today, the number is down to 1.14 billion, and that's a pretty significant drop and reflects strong buyback activity. The company also generates an impressive return on invested capital of 19%, which shows they're putting shareholder money to work effectively. On the debt side, net debt to EBITDA sits at 2.49. That's not too concerning, but it's something to monitor, especially in a rising rate environment where refinancing gets more expensive. Analyst price targets currently sit around $92, implying about 13% upside from current levels. So my personal buy range for Starbucks is below $80. Ideally, when the dividend crosses that 3% mark is where I like it. My own cost basis is between 75 and 76, so ideally down there. And I'm watching for more opportunities when the stock dips back into that zone. As of now, it's hovering just above my range, and if you're not in Starbucks already, then perhaps you might look for maybe a little more margin of safety, but this is a personal decision. I did manage to pick up a little bit last week when it dipped to $78 per share, and I plan to do more of this in May as these opportunities come. And part of investing is having the patience to wait out for those opportunities. And stock number 3 is Nike, ticker NKE. It's one of the world's most recognizable consumer brands, but also a company that's been struggling in 2024 and into 2025. Shares are down 40% from their 52-week high, with much of the decline happening in just the last few months. So what's driving it? Nike's latest earnings disappointed the market. Revenues dropped about 9% year over year, and sales in China fell 17%. It's a major blow for a company that's long counted on Chinese growth to drive its international story. In the US, the brand is facing weak demand, particularly for its signature footwear lines, and has been dealing with excess inventory, which has pressured margins. On top of that, tariff concerns have reemerged, with Nike pushing for relief on import duties that are adding cost pressure to their already strained supply chain. Given the uncertain tariff fallout that could hamper Nike's comeback, Simply Safe Dividends recently downgraded Nike's dividend from a score of 90, very safe, to 80, safe. Still suggesting the dividend cut is unlikely, but the pressure is clearly mounting. That downgrade reflects Nike's current elevated payout ratios. While they look fine from a historical standpoint, the forward payout ratio is at 95% of earnings and 72% of forward free cash flow. Now the real question is this just a temporary setback, a spike, or is this the new normal? Dividend growth surprisingly has been a strong point here. Nike isn't what most people think of as a traditional dividend stock, but the company has now posted 22 consecutive years of dividend growth, just a few years away from aristocrat status. The 5-year CAGR is an impressive 11%, and the latest raise came in at 8.1%. So if Nike can steady the business, this is a potential double-digit dividend grower in normal conditions. Nike pays its dividend quarterly in January, April, July, and October, currently 40 cents per share, for a total annual payout of $1.60. The next ex-dividend date is June 2nd, payable July 1st. Now, if Nike does pull off a successful turnaround, this could be an opportunity to lock in historically high starting yield of about 2.8%, miles above the 5-year average of just 1.13%. By dividend yield theory, that's a strong undervaluation signal. But from a PE standpoint, Nike looks less obviously cheap. The forward PE is around 34.1, which is basically in line with its 5-year average. Nike has been consistently reducing its share count over the last decade, going from 1.77 billion shares outstanding 10 years ago to 1.5 billion today, a clear sign in history of long-term shareholder focus. It boosts earnings per share and signals confidence from management in the company's valuation. Return on invested capital is strong at 14%, which tells us Nike is still very efficient at turning capital into profit. That kind of ROIC is what you expect from a well-run premium brand with global reach. The balance sheet is rock solid. Net debt to EBITDA sits at just 0.34, and net debt to capital is only 10%. That means Nike has plenty of financial flexibility, which is especially important in a period of weaker sales and potential macro pressure. There's no danger of being over-leveraged. The average analyst price target for Nike stock is at $74.14, which represents about 30% upside from where shares are trading today. I'm not personally buying Nike right now, but for investors willing to take on some risk, I think there is a real turnaround story in the works. It's on my watch list, and with the stock down this far, the risk reward is starting to look a lot more attractive, a lot more appealing to me. So we'll see. I believe the brand strength and management's financial discipline will reign supreme. I do hold positions in both UNH and Starbucks, and I'm continuing to look for chances to add to both. Today's stocks, I'll carry a little extra risk, I think, than what I normally talk about on the channel. Just to keep this in mind, this is all about finding a bargain for that turnaround, that upside. People can make a lot of money in times like this. Let me quickly talk about a few other stocks that I could potentially be buying here in May. I'm still going to be buying Chevron, ticker CVX. It took a big hit around April 1st, now yields close to 5%. I actually have a full video breaking that one down, which is why I didn't include it today, so I'll put the link in that description. I'm also eyeing PepsiCo in my Roth IRA. It just hit a 52-week low, and yeah, there are real headwinds, but that's what creates long-term opportunity. I made a video comparing it to Coke, ticker KO, and why I laid out the case of why Pepsi is the better buy right now, so I'll go ahead and put that in the description too. Yesterday morning, I actually added a share of Johnson & Johnson to my Roth IRA. While it's not necessarily as beat down, I do think it's fairly valued, and I love their consistency and will continue to look for more opportunities to build up that position more. And of course, I'll be steadily building my ETF positions. So my 401k, I always buy S&P 500 index. In my Roth, I'm buying an SCHD and SCHG. And in the public dividend growth income portfolio, which I just shared with you guys, I will be beefing up my positions in VOO, SCHD, and VYM. So let me know in the comments, what are you buying in May? And if there's a stock you'd like to see featured on the channel, why don't you go ahead and drop that below as well. Thanks for watching, and until next time, keep investing.